option under the CARES Act here. So basic market conditions right now, we've got some changes happening due to liquidity issues, capacity issues with lenders. That's just really fancy talk for, you know, the health of the financial market and the functionality of what's happened, how mortgages are funded, bought and sold on secondary markets. Okay. And the bottom line is that the credit box has tightened a little bit, meaning that you need a little stronger qualifications in terms of credit and reserves in particular for qualifying. Also, under the CARES Act, if you're a homeowner and you're having trouble, or you're having a financial hardship, or you lost a job or went into furlough, the CARES Act has offered a forbearance option that servicers will give you. But there's a lot of misinformation regarding that forbearance option. A lot of people think that forbearance is forgiveness.
Yeah, they do.
And it's not. It's just a deferment of the payment. So think if you went and bought a furniture piece on layaway, you still owe the money, you still accrue interest, but they let you pay it later, which can be good for people. But what people don't realize is that it's a balloon payment at the end of a 6-month forbearance in most cases. Sometimes they'll tack it on to the end of the loan.
Okay.
But in the first scenario, it's a very risky option because you have to come up with 7 payments at one time in 6 months from now. So if you can't make your payment today, it's highly unlikely in 6 months, with most people's debt ratio here in California especially, that they're going to be able to make 7 payments at one time after a financial hardship. So the statistics on it is it really increases the probability of default. So be very careful. Your best option is always to make the payment if you can make the payment. Okay. And if you can't, and it's absolutely necessary, that's when you want to pursue forbearance options. So I just wanted to touch on that because it's a really hot topic right now.
Who should homeowners be calling?
Yeah, I mean, you can start with your mortgage professional. We're always a good option. Obviously, we're service-based, relationship-based, so you can start with us. But in reality, to implement a forbearance option or determine your options, you have to call your loan servicer. And they're inundated with calls. So it takes a very, very long time. Okay. I would recommend you start with whoever originated your loan. I am happy to help somebody, whether I originated their loan or not, and explain their options and take a review of their situation. An alternative right now, if you can qualify, mortgage interest rates are incredible. And I think our next topic is whether or not you can buy or refinance right now.
Yes. So let's jump into that question. So I have a bunch of people asking me, hey, can I even buy a house, or can I even refinance right now? What would be your answer to that?
Absolutely. Markets are struggling, of course, but liquidity, options to buy or refinance are still there. Refinance is a great alternative to forbearance. If we can do some debt consolidation, you also can skip a mortgage payment when you refinance. That will provide you some relief out of pocket. We can even structure a refinance to skip 2 mortgage payments and build that into the loan. It's a much better option than forbearance. But to answer your question, both purchase and refinance loans are available, and even up to high loan to value ratio requirements. As a broker, I've got access to many different lenders instead of just working for one. And a lot of lenders are dealing with this financial crisis in different ways. So as of right now, I have access to almost every product out there other than the jumbo and the non-QM market, which is a very small percentage of home buyers.
Okay. And so jumbo, can you kind of talk a little bit about that and just briefly touch on that? Like, what is a jumbo loan for people who are watching?
So there's only been a few changes to the conforming loans, and conforming loans are 0 to 510,400. They're readily available. They're excellent interest rates. We have low 3%, 0 points, 30-year fixed rate mortgages, and even high 2s on 15-year fixed rate mortgages. Then you have conforming high balance, which goes from $510,400 and $1 to $690,000 in San Luis Obispo County. Anything above 690 is considered a jumbo loan option. But we are able to mitigate the lack of those options in the market with a first and second combo utilizing a home equity line of credit. So I can still service those folks, but you have to do a split loan scenario that was a little more prevalent in previous decades than it has been recently.
Okay. But you can get creative and you can still help people if they wanted to do jumbo.
Yeah, absolutely. And that equity line product is based on the actual federal funds rate, which affects the prime interest rate instead of mortgage-backed securities, which is what forward first mortgages are based on. And so prime interest rate is at 3.25. If you have a margin of roughly 0.75% off of that, you're getting a 4% or 3.99% on an equity line right now. Excellent alternative, very low interest rate, little riskier loan though, because it's variable and it works more like a credit card for 10 years where you can borrow and pay back against it.
Okay. But if someone wanted to use this as an option, obviously they could talk to you and you guys could go over what options would be best for them.
Yeah, I think the best thing is to talk to somebody that is competent, knowledgeable, and up to speed on market changes so that we can review all options and make sure you're put into the best position possible.
Okay, great. So let's talk about interest rates. I know you kind of touched on it just a little bit. What are they looking at today?
Yeah, so anything up to that 510,000 number, like I said, is extremely attractive. We're low threes, anywhere from 3.125, 3.125, 3.25, 3.3, 0 points right now. I'm still offering with good qualifications. With some risk factors involved, credit score, loan to value, you start to climb up into the 3.6, 3.8 range. But still historically low interest rates. I'm going to touch on that in a little bit with a graphic. And then obviously those equity line rates are attractive with the prime plus a small margin hovering around 4%.
Okay, wonderful. So I always like to see numbers, and I wanted to do like a real life scenario with you. And I know that you have that on your screen. So why don't we share your screen? Okay. And you can give us some loan scenarios where we would put 5% down, 10% down, and 20% down. And then for those watching, they can see how that breaks down to down payment, interest rate, and mortgage payment.
Yeah, thank you. And Teri, just let me know. Can you see the screen good? Are you good to go?
Yeah.
Okay. All right. So the first thing I want to touch, I'm using in a sample listing here that the Keenan Group, which is your group there at Keller Williams, is listing. So I thought I'd use that. So 1034 Ford Drive in Napomo is a single family residence here that the Keenan Group has listed at $620,000. It's a great price point. It's a median price point in our county. I think we're just slightly above that as the median home value here in the county. Beautiful home. So I just want to touch base on, what we're looking at. This is the house in the financing scenario that I'm going to go through. Beautiful single family residence in Napomo. So regarding that, I've put together 3 loan options here for everyone to take a look at. And I've got a 5% down conventional, a 10% down conventional, a 20% down conventional. So as little as 5% down and we can go conventional on this home. And at a rate of 3.5%, you put 10% down, I can go to 3.375%. All these are quoted at 0 points. Okay. And I'll get into the mortgage insurance options. And then at 20% down, no mortgage insurance, 3.5%. Now you'll see here, it's actually slightly worse on the rate with 20% down than it is at 10. Why is that? Yeah. It's because with less than 20% down, the lender is insured through a mortgage insurance program. So let's take a look at what that cost is and how it compares. But that's an interesting dynamic that most people don't know. A 10 or 15% down loan is actually a slightly better interest rate than 20% down. And that's a big myth out there is, I got to get to my 20%.
Right.
So scrolling down here, here's your Ford Drive property. These are the breakdown of the 3 options that we have here. So the loan amount with 5% down is $598,300. 558 or 496 there. And the down payment required, you can get into this home with as little as $21,700 down plus closing costs, which is incredible.
That is.
A lot of people don't realize that. They think they need the $124,000 here under the down payment at 20%. So let's talk about how that affects and what those mortgage insurance factors are with less than the 20% down. Here you can see 20% down, no mortgage insurance, 10% down, $79 a month, very reasonable. Considering you're saving, your down payment's roughly half, right? 122 to 62 for $79 a month. It's a really attractive cost of funds there. And at 5% down even, you're only paying $117 a month on the mortgage insurance. So this is how it breaks down on a graphical model here. The total payment that we're quoting here includes your principal, interest, taxes, and HOA. There's a $350 HOA on this program.
Yeah, it's Trilogy there is.
Okay, so these are all inclusive payments. 5% down, you're going to pay $36.65. 10% down, $34.45, and 20% down, $32.05 a month, all inclusive for this $620,000 home.
So all in prices.
All in.
Okay.
All in, inclusive of everything.
Mm-hmm.
And we break it down by graph here. So the blue is the principal on payment number 1. The gray is the interest. The purple is the taxes, and this is your homeowner's insurance. I'm sorry, yeah, your homeowner's insurance, your mortgage insurance, and the HOA fee of $350 for this particular property.
Okay, got it.
All right.
That's the 5% down option.
That's right.
Okay.
That's right. And the loans over time, you can see this 20% down option is the best over time, but it requires a huge cash outlay, and it's really not a big difference, you know. So this is a 10-year chart, and most people are in a home 7 to 10 years.
Right.
It's a good look at where you would stand with each loan option in terms of your equity position and your net costs here on graph number 1. So those are 3 different options. And I think the main takeaway for people here is that you don't need 20% down to buy a home. And when you compare this after tax, home ownership after tax versus what you can rent for, it's a very attractive rent versus buy analysis for a lot of people that are paying, you know, rent into the 3,000 plus range.
Yeah, no, 100%.
Mm-hmm. Yeah. Any questions on that, Teri?
I don't have any questions on that. Does anyone watching have any questions? I know that I see a couple of questions on we're feeding this on Instagram too for all of our Facebook viewers. Mm-hmm. Are you ready to answer a question, Justin?
I'm ready. Fire away.
So Ronnie Haro, who's actually one of our past clients, said, what if I just purchased on an FHA loan? Can I refinance to a lower rate?
That answer is yes. You can refinance to a lower rate. There are still refinance options that, and Ronnie has a unique situation with the FHA because FHA has a refinance program called a streamlined refinance program. The streamlined refinance program, I'm going to come off the share here, guys. The streamlined refinance program historically has been one where you can qualify with no income, no asset, and no appraisal because FHA already insures the loan. So they'll simply rewrite you to the current market interest rate. And a lot of times that's a very attractive position. Currently, I don't want to misspeak here, Facebook Live. I would want to do a little homework for Ronnie in terms of those streamlined program options, because I know that's one of the main loan programs that have been affected pretty drastically by the COVID-19 crisis. And that primarily has to do with the forbearance issue I touched on before. So government loans in particular, you know, I don't know how technical I need to get here, but the FHA program is being impacted pretty greatly by that, and especially on the refinance side of things. So we'll have to take a closer peek at what the current qualifications are and different lender overlays for that. And I can get back to Ronnie on that. But yeah, refinance is an option, and FHA is typically a very attractive one.
It is. So do you want to talk about that? I know like a lot of our clients are familiar with FHA. They hear about that term a lot. So do you want to talk about how with the COVID-19? Okay.
So the reason that FHA is having a tough time and why FHA rates are higher than they should be based on technicals in the mortgage-backed security market, you know, I am going to share my screen one more time here to answer this question. But the bottom line is this, guys. The FHA program, when a loan is issued, it gets serviced by a servicer, and that's who you make your mortgage payment to.
So that could be Wells Fargo, Chase, Bank of America, right? That's what a servicer, just examples for the people watching.
That's right. And it could be bought or sold, and you've probably experienced that. So the person on an FHA or VA loan, the person that is servicing the loan, not person, but company or bank, They owe a bondholder the principal and interest every month, whether you make your payment or not. And that's not the same on a conventional loan. So that's why the FHA program is having a lot of trouble right now. And there is a liquidity facility for this that should be easing things recently. The government is very aware of this issue, and they're making steps to remedy that. So I expect FHA rates to come back down very drastically here in a short period of time. And that might be the opportunity that Ronnie and other FHA loan holders are looking for. But the bottom line is, when the servicer is not collecting the payment from the customer because of forbearance, they still have to pay the principal and interest to the bondholder. So it's made that paper as an investment very, very unattractive on the secondary market. And therefore, to get new FHA loans on the books, the price has gone way up to the customer. Okay, so that's one of the programs that has been impacted greatly. It's still available. It's an excellent program, but it's harder to qualify right now until we get through COVID-19. So I want to talk about the market here. And the screen that I have on here is that mortgage-backed security market here. This is the 30-year fixed 2.5% coupon. The higher this value, the lower interest rate should be on a technical basis. Okay, and this is a last quarter here. So this is the last 3 months, that is.
Okay.
When this price gets higher like this, you can see this regression line right here. There's an increasing trend, guys, and that should point towards lower interest rates. But a normal functioning market, it would. In this market, we have capacity issues, we have secondary market liquidity issues, and so this isn't driving the interest rate as much as it should be. Rates are still good, but they should be better. And the reason for that is the primary buyer of this bond in order to drive this price higher here is the Fed. Regular investors, private investment hedge funds, and regular, institutional investors are not buying. And this is a normal functioning market. You see how these are really low? This is the COVID-19 crisis where you can just see extreme volatility.
Yeah.
And now we're starting to stabilize because the Fed's whole goal right now is to stabilize. The point I want people to take away from this is that when you look at this overall trend, rates are getting better. So as the economy pulls out of COVID-19, we're likely going to see very, very attractive interest rates. And what I would recommend to everybody is to get with your mortgage broker, get an application on file, and get ready, because there is going to be a capacity issue again. And if you're not ready and prepared like anything else, then you're not going to be able to take advantage of it in the best way that you possibly can.
And talk about, the capacity issue, because we just saw that a couple weeks ago, right? When rates were, I've had friends who were getting rates, in the 2s.
Yeah. So I'm talking about capacity at this point in time as it relates to operational capability. In other words, how many loan applications any given lender can process at one time. A few weeks back, I think it was March 18th, approximately, when interest rates bottomed, lenders took on roughly a third of the entire average annual volume in refinance volume in 1 week. So it puts tremendous pressure on operational facilities to be able to process all of that. And so what lenders do, because the demand is so high, is they jack up the price to slow the application volume. And so even though back on that chart I was showing rates technically should be better, the lenders aren't offering the better rate because there's more volume than they can handle.
Mm-hmm. I think it's really good that you're explaining it, because, some people are like, hey, I heard, John Smith got a 2.9. Why am I getting quoted, 3.3? Well, this is why.
Not only are there differences in borrower qualifications, but the market is extremely volatile on price, and it's extremely volatile from lender to lender. That's another reason, as a broker with many different options, I'm poised in a really good position to take advantage for people in this market. And so I'd love to help if you guys are out there looking for that. But the volatility is the reason primarily. And as I said, the Fed is starting to stabilize the market. Look for, when we go back to work, when the economy starts to come back, for very attractive interest rates. That's what we're expecting.
Okay, perfect. And then, hey, Ben Tilbury, he had a question. Can you still do FHA 203K loans right now?
Currently, those have been suspended at almost every lender, if not all lenders. So off the top of my head, I haven't done a complete search for those as an available option. I have an idea of where to go because there's what's called non-bank lenders and bank lenders. Non-bank lenders are having very big liquidity issues. Bank lenders are able to actually pull from their own capital, okay? And when I say bank versus non-bank, there's plenty of options for bank lenders for brokers. So I'm not talking about, does a loan officer call himself a banker or a broker? I'm talking about the actual lender that's issuing the loan or buying the paper from the loan officer's company. Because that term is really thrown around, but I'm talking about the actual lender making the loan, buying the paper from the delegated or correspondent lender, which is really just a broker too. That outlet, if it's a bank, may still have that product available. So I can get back to Ben on that one.
Yeah, that would be awesome. Okay. I think we went over the questions from our viewers. I don't see any more. Is there anything, Justin, you want to touch on? I feel like you did a really good job in a good amount of time.
What I will do.
How can people get in touch with you? Sorry.
Yeah. So what I'll do is I'll follow up in the links below with a couple different resources. Check my Facebook page, assisthomeloans.com. I'm going to post in the comments here after we finish up here. I'm going to post a couple different things. One is going to be a link to my online application. There's no cost or obligation. We don't run credit until we speak, but that will get an application on file for us so that we can get you poised in a position ready for that refinance. If you are thinking about doing it at some point in the future. The other link that I'll put in there is a Calendly link to schedule time. If you have questions, I have a 15-minute link to schedule a 15-minute phone call with myself. You know, if you want to schedule time, if you're having an expected employment reduction or layoff or anything that I can help with during this crisis, schedule time with me with that link, and I'm happy to walk through your specific scenario and try to help you in any way that I can.
Awesome. We did have another question come through.
Okay.
In regards to deferring payments, how is that going to affect the borrower's credit in the long run?
That's a great question.
Great question, Carly.
Yeah, excellent question. So there's a couple things. Part of this CARES Act and Forbearance and Relief Act, you're only guaranteed what the government said in the CARES Act if your loan is federally backed. So you need to check with Fannie Mae, Freddie Mac, if your loan is owned by Fannie Mae, Freddie Mac. There's links that I can also post to that where you can check. If your loan is government backed with a FHA or a VA loan, then you also are federally backed. In that event, it won't affect your credit score, but it will be posted on your credit as the fact that you entered into forbearance. So while your score is not going to drop, future lenders and your future ability to transact could and likely will be impacted. Currently under current conventional guidelines, if you have a forbearance, you need a 12-month on-time payment history after you've caught up before you can qualify. I fully expect that to continue, even though they're not going to ding your credit score. You're still going to be in a waiting period for the derogatory credit event in order to qualify down the road. So you need to be very careful, especially if we are headed into a really attractive rate environment and you do want to refinance down the road, you need to make your payment. Don't go into forbearance because it's going to disqualify you from, most likely going to disqualify you from approving in a short period of time down the line.
Okay, perfect.
Yeah.
And then VA, how can people, VA buyers still buy and refinance right now, or is that the same thing as FHA?
Well, both programs are available. It's the price of the program that is not as attractive as it should be. And so we can still potentially help borrowers. We just need to look at the scenario, run pricing. That would be an excellent opportunity for that 15-minute call where I can jump on there and try to help somebody with their specific scenario. But FHA and VA are still available. They're still funding, and they're receiving the stimulus they need to remain in a liquid position where those loans will continue forward.
Okay, perfect. Yeah. I think that's it. Thank you.
Got it.
Any other questions, you guys? It Doesn't look like it. So yeah, we'll end this call. Again, Justin put all your information and the links in the comments in Facebook. I will give you a shout out too on Instagram so that people know how to contact you on Instagram.
Wonderful. I appreciate you guys having me. Everybody stay safe and healthy out there.
Thanks.
Cheers.
Bye.